Chapter 14, Part 1, Bonds Payable, and this section we're going to cover interest payments using the straight line and effective rate. Now, issuing bonds. Bonds, it's known as a bond indenture. It always includes two payments. One is going to be the amount owed at the end of the period or the maturity date, plus there is going to be interest payments, and usually these are semi-annually. So the sum of the money, which is the face of the bonds, and then you're going to have, which is what you have to pay back, and then we're going to have the periodic interest at a specified rate on the maturity amount. So, paper certificates, normally they sell $1,000 face value. Interest payments, usually made semi-annually, but make sure you read the problem. And used when the amount of capital needed is too large for one lender to supply it. Now, when we issue bonds, we're going to have some challenges, and the first is we have to figure out the cash that's going to be received, and it's all based on the effective or market rate less any bond issue costs. Now, you're going to first determine, was it issued at a discount where the cash is less than the amount owed, or a premium, the cash is more than the amount owed. Then we have costs associated with issuing the bonds. There's a new rule now that shows that costs associated with issuing the bonds is treated as a reduction in the cash proceeds and an increase in the discount or a decrease in the premium on bonds. This will cause the effective rate to increase for discounted bonds and decrease for bonds sold at a premium. And then, of course, we have the paying of the interest. If issued at a discount, then interest expense will be higher than the stated rate. If at a premium, then interest expense will be lower than the stated amount. And then we'll talk a little about what happens when the bonds are retired. Now we're going to take a look at a problem. Now, Leon Dion Company issued $600,000 of 10% 8-year bonds on January 1st of 2021. The interest is payable semi-annually on January 1st and July 1st. Dion Company uses the straight line method of amortization for bond premium or discount, and the effective rate, it was 8%. So what we're going to do is we're going to record when we issue them, but of course first we have to determine how much cash did we receive. Then we're going to do the interest payment for the 2 periods, and then look at what is it carried at the end of the year. So, what information do we need? We need the face of the bond and the interest, because this is going to determine the amount of interest that we're going to pay in cash. We need to know how many years, because that's going to tell us how long we're going to amortize the discount or premium. And we need to know when. And then we have to know when the interest is paid. In this case, it's semi-annually. We need to know what method they're using. And we also need to know what the effective rate is. So here's the thing you have to deal with is, again, we have two cash payments and semi-annual payment. Okay, the face of the bond. This is the amount to be paid at the end of the bond term. We go to the present value of $1 table and select the factor based on n equal the periods, and if the interest is paid semi-annually, we take the years times 2. And I is the effective rate we divide by 2 because we're paying semi-annually. Now, to determine interest expense, what we're going to do is we're going to say for the interest payments, go to the present, what we're going to do is figure out what is the present value of the interest payments, So we're going to go again to this case, since we're going to be getting payments over time and they're of the same dollar amount, we can use the ordinary annuity table. And the reason we use this table is because the payment's always at the end of the period. If we were having the payment at the beginning of the period, we'd use the annuity table for an annuity due. But whenever you're talking about bonds, it's just your ordinary annuity table, and we select the factor based on n equals the number of years times 2, and interest is the effective rate divided by 2. So remember, whenever you go to the tables, you're always using the effective rate. All right, here's the present value table. So what we're going to do first is we're going to go, it's 16 periods, so we're going to go down to this row, and then we're going to go across to 4%. And that's the factor we're going to use on the amount, the lump sum that's going to be paid at the end of the period, which is the $600,000. Okay. Now we're going to go to the present value of an ordinary annuity table. Again, we're going to go to 16 periods, and we're going to go to 4%, and that's the factor. We're going to take that times the cash payment that would be made every 6 months, based on the face of the bond times the stated rate. So, first we're going to take the face of the bond times the present value factor. So in today's dollars, based on 8% annually, it's worth $320,000 in today's dollars. Then we're going to look at the interest payments, which are going to be $30,000 every 6 months times the present value of annuity factor. We're going to add that up, and now we know that we're going to receive $669,915 when these bonds are issued. Now, first we do the bonds payable, which is always the face of the bond, or the amount that is paid back. Then we can do the cash received. That is the cash received is always going to be the actual amount, which we're showing up there. Now, if you have to debit it, you have a discount. If you have to credit it to make them balance, you have a premium. Now we're going to do the journal entry. So the cash we know is the $669,915. And we know that the bonds payable is $600,000, so the difference we have to credit it, so that means we have a premium on bond. And it's always a premium when the stated rate is higher than the market rate. Now let's book the interest using the straight line method. Whenever you're doing the straight line method, the first thing you do is you book the cash. Then you amortize the premium, which is the premium divided by the years times 2. And then you can figure out interest expense. Once you figure out this journal, it is the same journal. When you're using the straight line method, it's exactly the same journal every time you book the interest. So, here's what our entry would have looked like. So remember, cash is always going to be the face amount of the bond, the amount that has to be paid back, times the stated rate divided by 2 if semi-annual interest payments. Then we're going to amortize the premium on bond. In this case, we're going to do it over 16 periods because it's 8 years, twice a year. And then we're going to add those two together. Oh, I'm sorry, we're going to subtract them. Now remember, when you issue bond at a premium, your interest expense is going to be less than the cash. And remember, this entry is going to be exactly the same every time. And when you're doing this method, interest expense is a plug. Now, what's our second journal look like? Now, it's going to go to interest payable because the payment is on January 1st. Now, what's the carrying amount? December 31st. It's going to be the bonds payable plus the premium minus the 2 interest payments, which amortize $44,370. So the carrying amount is going to be $661,175. Now, same example, But what if we'd issued these bonds and we're using the effective rate? So, when you use the effective rate, you calculate the interest expense by multiplying the effective rate times the net bonds payable each time you make a payment. Remember that when you use the effective rate, every time your interest expense is going to be a different amount because your balance in bonds payable minus the discount plus the premium is going to change because you're writing off that discount or premium. So again, we've already calculated this, and this journal is exactly the same as what we did previously. What's going to be different, though, is if we do our bond amortization table, if you look at this, you will notice that every single time our amount that we book for interest expense is changing. And it goes down because the balance gets less and less as we go through this process. Until at the end, the balance equals $600,000, which is the amount we'd pay at the end. Remember, the cash is always the face of the bond times the stated rate divided by 2 if semi-annual interest payments. And again, interest expense is always bonds payable plus, in this case, premium, the balance in the premium account, times the effective rate divided by 2. And this is always going to change. And you notice in the schedule it does. So now let's look what it looks like when we book the interest. So again, whenever you're doing the effective rate, you do the cash first, just like you do with straight line. The difference is your second entry is going to be interest expense, and the plug is going to be the debit or credit to premium or discount. So in this case, we have premium. So what we're going to do is we're going to debit it. So here's our actual journal entry. There's our cash. There's our interest expense. And there's our premium on bond. Now, what happens when we accrue our year-end interest payment? Interest payable, remember, always the face times the stated rate divided by 2. Interest expense is going to be the $669,915, which is the bond plus premium minus the $3,203 that you wrote off times 4%. So you're going to recalculate that interest expense every time, and then the plug is going to be premium on bonds. Carrying amount. The carrying amount is going to be bonds payable minus the balance in the premium on bonds. And that's going to give you your net carrying amount for your bonds. So remember, premium on bonds has already been reduced by 2 payments. And that ends this presentation, part 1.